Picture this scenario. You owe $5,000 on a credit card. You've been making your minimum payments every single month like clockwork, $132 every month on time. You feel responsible. You're doing the right thing. 3 years go by. You check your balance expecting to see some progress. Maybe you're down to $3,000 or $2,500, right? You've paid almost $5,000 in minimum payments over those 3 years. You pull up your statement. Your balance is $4,847. You've paid nearly $5,000 and you still owe almost exactly what you started with. You're treading water while actively drowning. You've been working, sacrificing, making payments, and you've gone nowhere. This isn't hypothetical. This is the mathematical reality for millions of Americans right now. And it's not because you're bad with money or financially irresponsible. It's because the debt system is designed, engineered actually, to keep you owing more than you owed, no matter how hard you try to pay it off. Let me show you how this trap works. My name is Mike from Data Makes Sense, where I spend an unhealthy amount of time breaking down the math that financial companies hope you'll never find. When I ran the numbers on what happens to the average credit card payment over time, I found something that genuinely made me frustrated with the system. According to the most recent data from LendingTree's 2025 analysis, the average American with credit card debt carries a balance of $7,321. The average interest rate they're paying, 22.83% for accounts accruing interest according to Federal Reserve 2025 data, and 60% of credit card debtors have been carrying that balance for at least a year, according to Bankrate's 2025 credit card debt report, some for 5 years or more. When I ran the numbers on what actually happens when you make minimum payments on that debt, I realized something. The system isn't designed to help you pay off debt. It's designed to extract maximum profit from your attempt to pay off debt. If you've ever felt like you're making payments but your debt never seems to go down, or if you've ever borrowed money to pay off debt and somehow ended up with more debt than you started with, make sure to hit that subscribe button and give this video a thumbs up. Because today, we're breaking down the debt traps that are mathematically guaranteed to keep you owing more than you owed. Here's what changed. According to the Consumer Financial Protection Bureau's 2024 analysis, over the last 10 years, average APR on credit cards assessed interest have almost doubled from 12.9% in late 2013 to 22.8% in 2023, the highest level recorded since the Federal Reserve began collecting this data in 1994. But that's not the interesting part. What changed is the minimum payment structure. Back in the 1990s, most credit cards required you to pay at least 5% of your balance each month as a minimum payment. That was still designed to keep you in debt, but at least you were making measurable progress. Then the banks did the math. They realized that if they lowered the minimum payment requirement to 2% of your balance, people would actually be able to afford the minimum. They'd feel like they were being responsible. They'd keep making payments, and they'd never, ever escape. This is what we call the minimum payment trap. According to Debt.com's payoff calculator analysis, at a 2% minimum payment on a balance with 22% interest, about 2/3 of every minimum payment goes straight to interest charges. Only 1/3 touches the actual balance you owe. Let's talk about what that actually means. You're not paying down $5,000. You're paying interest on $5,000 forever. Your balance barely moves because the interest is accruing faster than your minimum payment can reduce it. If you have a $5,000 balance at 20 to 22% APR and you only make minimum payments, multiple financial calculators show it will take you 17 to 23 years to pay off that debt, depending on your exact APR and minimum payment percentage, and you'll pay over $7,700 to $8,000 in interest on that original $5,000 balance, according to Bankrate's credit card payoff calculator. But wait, there's more. And by more, I mean it gets significantly darker. There are 5 types of debt traps that multiply your debt faster than you can pay it down. I call this the debt multiplication system. Trap number 1, the minimum payment illusion. Credit card companies set your minimum payment at roughly 2% of your balance. Sounds manageable, right? The average balance is $7,321. Your minimum payment is about $146. Here's the math they don't show you. At 22.8% APR, you're accruing about $139 in interest that first month. So out of your $146 payment, only $7 actually reduces your balance. That's 4.8% of your payment going to principal. The other 95.2% is pure interest. You're not making progress. You're making the bank rich. Trap number 2, the rollover loan. This is where payday loans and short-term lending become mathematical weapons. According to Credit Ninja's 2025 payday loan analysis, the average payday loan charges 391% APR. Some states allow up to 664% APR, according to WalletHub's payday loan statistics. Let's say you borrow $500 to cover rent. The fee is $75 for 2 weeks. That's a 391% annual rate. When the 2 weeks are up, you don't have $575. You have rent next month coming. So you roll it over, another $75 fee. Studies from Debt Hammer show that 80% of payday loan borrowers take out 11 or more loans in a row. They're not taking out new loans for new emergencies. They're borrowing to pay the interest on the old loan. The Pew Charitable Trusts reports that borrowers spend an average of 5 months paying off these loans, and the $500 you borrowed becomes $750 in fees over that period, and you still owe the original $500. You're paying rent on money. Trap number 3, the payment allocation. Shuffle. Most people don't know this, but credit cards have different interest rates for different types of transactions. Purchases might be 22%, balance transfers might be 18%, and cash advances might be 27%. Here's the trap. When you make a payment, the credit card company allocates it to the lowest interest rate balance first. So if you have $2,000 in purchases at 22% and $1,000 in cash advances at 27%, your payments go to the $2,000 first. The higher interest debt just sits there, compounding. This is legal, this is standard practice, and it's designed to maximize how much interest you pay. Trap number 4, the debt consolidation trick. People think consolidating debt will save them. You take out a personal loan at 12% to pay off credit cards at 22%. The math seems obvious, but here's what actually happens. You pay off the credit cards, you feel relief. Your credit limit is back to 0, and then life happens. Car repair, medical bill. You use the card just this once. 6 months later, you have the personal loan and the credit cards are maxed out again. Now you owe $15,000 instead of the original $10,000. You didn't consolidate debt, you added a payment. According to Federal Reserve data from 2025, 40% of American adults couldn't cover a $400 emergency expense without borrowing or selling something, many of them in dual-income households who've recently consolidated their debt. Trap number 5, the hardship withdrawal spiral. This is the endgame trap. According to Bank of America's 2025 Participant Pulse Report, hardship withdrawals from 401k plans are up 13% from last year. The average withdrawal is just over $5,000. Here's the mathematical carnage. You take $5,000 from your retirement to pay off debt. You pay a 10% early withdrawal penalty. That's $500 gone. Then you pay income tax on the $5,000, another 22% in most cases. That's $1,100 gone. You withdrew $5,000. You got $3,400. You used it to pay debt, but you also just gave up 30 years of compound growth on that $5,000, which at 7% annual returns would have been $38,000. You solved a $5,000 problem by creating a $38,000 retirement shortfall. I know what you're thinking. Just don't borrow money you can't afford to pay back. And theoretically, yes. But here's the thing. According to Bankrate's 2025 credit card debt report, 48% of Americans are using credit cards to cover essential living expenses, not luxuries, not vacations, rent, groceries, utilities. They're not being irresponsible, they're surviving. And when you're in survival mode, your brain doesn't calculate 17-year payoff timelines. You see $132 minimum payment, and your brain says, I can afford $132. You don't see, this will cost you $8,000 in interest over nearly 2 decades. Credit card companies know this. They design the statement to show you the minimum payment in big, bold numbers. The total interest you'll pay if you only make minimums, that's in tiny print at the bottom, if it's there at all. This isn't accidental. The confusion is the business model. Let me show you exactly how this works with real numbers. Let's say you have the average credit card balance, $7,321 at the average interest rate of 22.8% APR. Your minimum payment is 2% of the balance. That's $146 for the first month. Here's what happens. Month 1, balance, $7,321. Monthly interest charge, 22.8% divided by 12 months equals 1.9% per month, equals $139. Your minimum payment is $146. The amount going to your principal will be $7, making your new balance $7,314 after the first month. You paid $146 and your balance went down by $7. So let's say you continue to make these payments without interruption for 11 months. In the 12th month, you've paid $1,728 in minimum payments over the year. Your balance is now $7,053. You've paid down $268 of principal. You've paid $1,460 in interest. Let's fast forward. If you only make minimum payments till you pay off, it will take you 17 years and 4 months, and the total paid will be $16,246, and the total interest will be $8,925. The total you would have paid is 2.2 more than the original credit card loan. Now let's compare that to a payday loan because it gets worse. You borrow $500 at 391% APR for 2 weeks. The fee is $75. Studies show 80% of payday loan borrowers get trapped rolling over their loans 11 or more times. Payday lenders make most of their profit from this cycle. If you roll that over 10 times, here's the math. Original loan, $500, rollover fees, $75 times 10 equals $750. Total paid in fees, $750. You still owe $500. You paid $1,250 to borrow $500 for 5 months. That's a 250% total cost for a 5-month loan. The debt didn't shrink, it multiplied. Now let's look at the consolidation trap. You have credit card. 1, $5,000 at 24% APR. Credit card 2, $3,000 at 22% APR. Total $8,000. You take out a personal loan at 12% to consolidate. Seems smart. Your interest rate is cut in half, but you didn't fix the problem that got you into debt. Within a year, you have personal loan, $8,000 at 12%, payment, $266 per month. Credit card 1, $4,000 at 24%, you needed it for an emergency. Credit card 2, $2,500 at 22%, car repair. New total, $14,500. Your monthly payments went from $200 to $500. You added $6,500 in new debt while consolidating. Here's where it gets really interesting. Credit card companies and payday lenders don't want you to pay off your debt quickly. According to the Consumer Financial Protection Bureau's 2022 analysis, Americans pay roughly $120 billion per year in credit card interest and fees. The CFPB's 2024 report found that in 2023 alone, major credit card issuers charged an estimated $25 billion in additional interest fees just from raising their profit margins over the past decade. According to earlier industry data, banks made $6 billion in overdraft fees in recent years, almost exclusively from people with less than $1,000 in their accounts. Their business model depends on you staying in debt. When you make minimum payments, they make maximum profit. A person paying off a $7,321 balance over 17 years is worth $16,246 to them. A person who pays it off in 1 year is only worth $8,100. They want the 17-year customer. This is why minimum payments are set at 2% instead of 5%. This is why they offer balance transfers with introductory rates that expire. This is why they increase your credit limit without you asking. They want you to borrow more so you can pay them more interest. The system is designed to keep you borrowing. When two-income households became the norm, credit limits increased. When people started making more money, the cost of everything went up to consume it. And credit filled the gap. You can't willpower your way out of a game that's rigged at a mathematical level. So how do you escape? There's no magic bullet, but there is a framework. Instead of minimum payments, use the debt avalanche strategy. Here's how it works. List all your debts by interest rate, highest to lowest. Pay the minimum on everything except the highest interest debt. Throw every extra dollar at that one. Why? Because interest is the enemy. A $3,000 balance at 27%. APR costs you $810 per year in interest. A $5,000 balance at 15% costs you $750. Attack the 27% first because every dollar you pay down saves you 27 cents per year. Once the highest interest debt is gone, move to the next one. It's not sexy, it's not motivational, it's mathematical. Stop borrowing to pay off borrowing. Consolidation loans, balance transfers, hardship withdrawals. They all feel like solutions, but unless you fix the underlying spending problem, you're just adding a payment. Before you consolidate, ask yourself, why did I go into debt in the first place? If it's because your expenses exceed your income, consolidation doesn't fix that. It just masks it. Build a $1,000 buffer before attacking debt aggressively. I know this sounds counterintuitive. Why save money when I'm paying 22% interest? Because without a buffer, the next emergency goes on the credit card. You take one step forward, two steps back. The $1,000 stops the cycle. It's not about earning interest. It's about stopping the bleeding. Once you have that buffer, you can attack debt without creating new debt every time life happens. This isn't about the $7,321 or the $16,246 you'll pay if you only make minimums. It's about time. 17 years of your life, making payments, staying trapped. 17 years where you can't take risks, can't change careers, can't quit the job you hate because you need the income to service the debt. That's what debt actually costs. Not money, time, freedom, choice. When you're debt-free, you're not just saving on interest. You're buying back your ability to say no to bad situations, yes to opportunities, and maybe to uncertainty. That $146 minimum payment every month isn't just $146. It's the chain that keeps you working at a job you hate, staying in a city you want to leave, not starting the business you've been thinking about. The goal isn't to be debt-free so you can have more money. It's to be debt-free so you can have more life. Here's your next step. Pull out every credit card and loan statement you have. Write down two numbers for each one, the balance and the APR. Now you know exactly what you're fighting. Attack the highest interest rate first, using the debt avalanche method I mentioned earlier. Every debt you kill is a win, and honestly, watching those interest charges disappear feels better than almost anything money can buy. If this video made you realize you've been making minimum payments on debt that will take 17 years to pay off, do me a favor, share this with someone who needs to see it. Send it to the friend who keeps rolling over payday loans, or the family member who thinks consolidation will save them. We don't talk about the mathematical traps enough. We talk about the shame of being in debt, but we don't talk about how the system is designed to keep you there. Thanks for watching, and I'll see you in the next one.